going to start our discussion for today. This is Unit 3 and unit name is Risk Assessment. Broadly, we are going to discuss the pre-engagement acceptance activities. Before you go in any engagement with your client, so there are certain considerations you should keep in your mind. Then planning and supervision. Once you come in engagement, the next step is to plan and supervise your working schedules. Audit risk and materiality is the very important term for an auditor to understand that what could be the risk he has to face and what materiality is about and how to measure the materiality. Understanding the entity and its environment is very important, because if you don't know the business cycle or business style, business pattern of the enterprises or an organization, then you cannot do a very good audit. Then analytical procedures you have to apply to analyze the movements between the last year and this year, and consideration of fraud in financial statements, that if the management is involved in the fraudulent activities, so what are your roles and duties to do. And in the last, we have to discuss the illegal acts by the clients. So let's start our discussion. The first standard of the field works says the auditor must adequately plan the work and must properly supervise any assistance. The auditor has a responsibility to plan and perform the audit to provide reasonable assurance about whether the financial statements are free of material misstatement, whether caused by error or frauds. Now let's discuss the client acceptance. First of all, if a client is willing to engage you as your auditor, surely there should be some communication between you and the auditor, which will define the scope of your work, that what exactly you are expecting from the client and the client is expecting from you. So client acceptance includes the continued evaluation of existing clients and the evaluation of new clients. Concluding that the management lacks integrity causes the auditor to reject a potential client or to end up a relation with an existing clients. If you feel that client is involved in the fraudulent activity, the option is with you can break your relationship with the clients. Auditor should communicate with the preceding auditor before accepting the engagement. This is very, very important and very must, that if this year the client is going to change the auditor, so the new auditor should communicate with the previous auditor for the communication. The auditor is responsible for initiating the communication. It's not the responsibility of the client itself. This is the responsibility of the auditor to communicate with the previous auditor. For that, both the auditor and his or her precedent should obtain client permission to have discussion about the integrity of the management as well as the pertinent audit related issues. Now, in client acceptance, what inquiries we should discuss? The most important is the procedures understanding as to the reason for the changing in auditors. But all text-based or other sophisticated economies, they have standards that if you change your auditor, the new auditor has to communicate with the previous auditor and inquire about the client and what could be the possible reasons that which motivates them to change the auditor, and he has to see the legitimacy of the arguments as well. The client refusal to grant permission or to the procedure auditor's failure to respond fully required the auditors to consider the implications when deciding whether to accept the engagements. When the client is refusing the permission to contact with the procedure or procedure is not giving you the information, then the new auditor has the choice, which depends upon the circumstances, that he should opt for this engagement or he should not. The auditor should establish an understanding with the client through a written communication regarding the services to be performed. This should be ideally in a letter called engagement letter. This is the first letter, in fact, which is the intention to have the services of the auditor and explaining the role and the intentions to the client, between the client and the auditors. This is the must letter. Preparation of the financial statements is the responsibility of the management. Auditor is here to express the opinion on the financial statements. So, auditor cannot involve in any activities which are directly associated with the preparation of the financial statement, which will be in fact the violation. So, management representation letter should be distinguished from the engagement letter. So one letter is the engagement letter and one is the management representation letter, that management understand that the preparation of the financial statement is the responsibility of the management. Now this is a sample for engagement letter. This is, you can see here, that this is the company, they are certified public accountants, this is the date, this is the address and everything, the salutation is there. This will confirm our understanding the arrangement for our audit of the financial statement of this company for the year ended this month. We will audit the company financial statement. This is one paragraph. Then we will conduct our audit in accordance with generally accepted accounting principles. And while an audit induces obtaining an understanding of the internal controls, so they will put the internal control paragraph into. And then financial statements are the responsibility of the company's management. So any material statement will be on their shoulder. Our, as an auditor, role will be to express an opinion. And assistance to be supplied by your personnel, including the preparation of the schedules. As part of our engagement of the year ended, we also prepare the federal and state income tax return. So this is additional scope has already been defined in the engagement. Our fee will be billed as work progress. So fee paragraph is also there. And in this letter, correctly express your understanding, please sign the enclosed and send it back to the auditor. So you can see these paragraphs are very important to keep in mind. These are all related to the engagement letter. This is the first communication between you and the client. Now let's discuss the planning and supervision. Audit strategy. Planning continues throughout the audit. It initially involves developing an overall audit strategy. Once you agree the engagements, now there are certain things to go ahead. First of all, you have to see, you have to understand the entity, its business, how many branches they have, what would be the scope of audit, how many guys you will be required to debut on that one. Do you have enough resource competence to do that one, or do you need any extra, you can say, the outside third-party assistance for your engagements? For example, if you are going to audit some chemical company, which stock valuation and which will be the scope of the work. So, being an accountant or certified public accountancy firm, you might not have expertise to measure you don't know the formulas to measure the inventories. For that, if you have to hire a third party who have expertise to measure and value the chemicals or any items which is beyond the scope of a normal accountant, then it is encouraged to have the third party which will do on your behalf. So audit planning depends upon the size of the corporation and the complexity of the business operations, number of employees, and the procedures and the multiple locations. These all things will determine your audit strategy. Audit plan must be developed and documented for all audit engagement. This is a must document an audit plan. It includes the nature, timing, and extent of the procedure expected to reduce audit risk to an acceptable level, acceptably low level. Now, once we'll go in the deep detail, first of all, we have to assess the materiality levels, then we have to define the test of control, that how much we have to test the client. If the client is competent, he has competent staff, he has good effective internal control systems, then the work of external auditor will reduce, because he is going to depend on the work of the internal auditors. And generally, if you know that if you are a qualified CPA, you are an external auditor, and some CPAs are sitting in the internal audit departments. So, they are like you, they are experienced, they have competency. So once you go to audit, and you find the competent qualified staff, they have required experience, they have required system, they are doing very good. So it will be a great comfort for the external auditor, and he will not try to go in deep substantive procedures, and he will reduce his testing and the audit approach, and his materiality levels and his risk assessment will become a little easier for him. So the audit plan includes a description of the risk assessment directed towards the risk of material misstatement, that is shortly called as RMM, that is risk material misstatements. Because as a core function of an auditor, he has to express that there is no material misstatements in the financial statements. So this will remain the core issue, and we will keep discussing this one. Risk assessment procedure are performed to obtain an understanding of the entity and its environment, including its internal control, to identify and assess the risk material misstatements at the level of financial statements and as a whole. You want to check that either only financial transaction has a risk and test of control for other operational tests, both will be the part of your risk assessments. The RMM is the combined assessment of inherent risk and control risk. What are inherent risk and control risk? Every company has an audit risk. What is an audit risk? That in spite of the full methodology and the expertise of the auditor, he will still not able to give an expert opinion and show that he will be failed to show the right picture of the audit. Now, audit plans are the part of audit documentations. What is audit documentation? Whatever audit you are going to do, it will be documented. You will prepare the files, permanent files and temporary files, and these files will have their own, you can say, the required documents, which we'll keep discussing in this course. Based on the audit strategy, the auditor develop a detailed audit plans. Now, what is the procedure in planning? Includes reviewing prior audit documentation. In last year, files will be with you. You will review that one. Discussing audit matter with CPA personnel, inquiries about current business development, reading the current internal financial statements, considering the effects of accounting and auditing pronouncements, coordinating the assistance of the entity personnel for data preparations, determining the involvement of consultants if it is required, and establishing the time of the work, establishing and coordinating staffing requirements. So you have to discuss with the old auditor, you have to see the documents, then you have to discuss with the management for the different, what new projects they are doing, what they are involved into to get the business sense. And then you have to see the requirement of the staff and how it will be placed. Planning also involves determining whether and to what extent the services of IT, tax, and other specialists will be required. For the big companies, obviously you will go for a system audit as well. If they have a big ERP system, so you will use your CAD, computer-aided assistant techniques. These are the advanced audit tools that you embed with the normal ERPs, and they will give the system audit as well. Auditor should communicate the client's scope and timing of the audit to those charged with the governance. These are generally the audit committee they have to deal with if you are talking about a corporate company. But the communication of this overview should not comprise the audit, for example, by making detailed procedure too predictable. Initial audits. The following are the example of additional planning considerations. One is the performance of procedure in accordance with the quality control elements, acceptance of client and specific engagements, communication with the prior auditor as we discussed before, major issues discussed with the management, planned audit procedure regarding opening balances. Let's discuss the materiality. Materiality is something which is significant. For example, if you have $10 and you lost $6, this is a material amount for you. But if you have $10 billion and you lost $6, this is immaterial for you. So as an auditor, first of all, you have to identify the level of materiality. That what things consider, what level will be considered material for this kind of organization. So materiality should be established for the planning process. It may be adjusted as audit evidence is collected, and material balances and location should be determined. Supervision involves directing the efforts of assistant who are involved in accompanying the objectives of the audit and determining whether those objectives were accomplished. Supervision is always as a supervisory role to keep a monitoring of the audit procedures. Now, audit team members should be informed about the suspectability of the statements to the material misstatement due to the error or fraud, but especially fraud. Fraudulent activity is something which is immense for the management. So those areas which are caused and affected by fraudulent activity should be highlighted during the audit. The discussion aids in understanding the entity and its environment. Suppose if you have suspectability for the cash control, how the goods are delivered, these are all suspectability should bring in the knowledge of the auditor. So he can put his, you can say, substantive testing, test of controls, and analytical procedures on the audits. And we should emphasize on the professional skepticism. Due professional care has to be used. This is referred to our study unit 1 where we discussed that we should be professionally groomed, competency should be there, and it should be fair and objective. Assistant should be informed about their audit responsibility and the objective of the procedures. And procedure should be implemented and followed for the resolution of the differences about auditing and accounting issues. Let's discuss the internal audit plans. Internal audit plans differ from those written by the independent external auditors. Institute of Internal Auditor, that is IIA, must evaluate and improve the effectiveness of governance, risk management and control procedure. This is what we discussed in BEC when we were discussing the corporate governance, that the internal control activity should focus on the risk, governance and management, so they can bring the quality of operations in the company.